Dear friends and investors, welcome back to another monthly of issues relating to markets and investing. So what are we going to talk about this month? We will touch upon 4 topics. One is the resurgence of the virus called Omicron and what we think and the possible impact on the investing landscape. Second is that we had the Fed chair, Jerome Powell, almost take a U-turn and talk about the future of the Fed policy. Third is that we now have data about the aggregate earnings picture in the second quarter that just went by and what it means. And lastly, we will talk about the continuing strength of domestic equity participation in India's markets. So let's start with Omicron. Obviously, when we all thought that it's almost getting over and we had something like a new variant which was found in South Africa, which really spooked everybody around the world and markets. And we had reimposition of travel restrictions from some of these African countries where the virus was first found. So the question really is that should we be really worried about this new variant? Firstly, we believe that we do not know enough as yet about this variant. Secondly, even in South Africa, where the virus was first spotted, after the initial surge, we are seeing that both case counts and deaths have stabilized. We've also seen this variant now move to other countries, but the case count continues to be very, very low. And in India itself, we've seen almost 21 cases of Omicron. And considering the previous experience that governments have got, everybody is on high alert. So what do we know so far? I think from all that we have read from reliable sources, one thing is very clear, that if the population is fairly vaccinated, or if an individual is vaccinated, then the symptoms, even if you get the virus, are fairly mild. It does not call for hospitalization, and therefore one should not panic about what happened, for example, during the second wave of the virus. But more importantly, I think after initially the markets getting spooked by the Omicron virus, I think things have stabilized thereafter. And the reason is very simple. As we've oft said, that typically markets tend to discount a risk which it doesn't anticipate much more violently than something that it already knows, right? So I think like every time you try to create a risk perception in the market because of the virus, I think the marginal utility of that risk perception will keep falling. So in my view, I think that we should not be unduly worried about what Omicron can do to markets in any sustainable way. And therefore, our belief is that just like we've adapted to the second wave and the subsequent waves around the world, unless governments panic and create massive lockdowns and restrictions, which we believe is a very low probability event, I think the markets will take this new wave also in its stride. Moving from Omicron, the next most important event which everybody around the world and investors were looking for was the next move of the Federal Reserve. And as you all know, the Fed chair Jerome Powell got renominated. And I think recently they did mention that he almost did a U-turn by saying that inflation is no longer transitory, and therefore the Fed could be looking at winding up its bond buying program earlier, which means that slowly and steadily the excess global liquidity at the margin will begin to start getting tighter. And this, in my view, was inevitable. It was never a question of if, it was always a question of when. And I think in a way it's good, because markets weren't really convinced that inflation is transitory. What does it really mean? I think what it means is that we will see liquidity being withdrawn slowly and steadily. We will also probably see a resumption of Fed rate hikes starting to happen. And all the data that we are seeing from the US economy and including in India suggests that the economy continues to be very, very strong. And as we've reiterated a couple of months back, and I thought it was important that we reiterate in terms of the prior historical experience of what happens to markets when bond yields start to rise. If you look at the data, and this is something that we've presented before, but you should see again, is that there were two instances in the last several years. One was when the federal rate hike between May 4 and September 6 was to the extent of 432 basis points. During that period, Nifty was up 45%, emerging markets were up 29%, and global equity markets were up 13%. Similarly, we had a hike between October 16 and April 19. This time the hike was about half of what it was during May 4 to May 6, roughly about 237 basis points. Even during that hike cycle, if you look, Nifty was up 11, emerging markets were up 9%, and MSCI Global was up 8%. And mind you, these are all dollar returns. What we want to say is that rising interest rates are not necessarily bad for equity returns, because usually the Fed rate hiking cycle usually happens when the economy is chugging along and doing very, very well. Well, initially there could be instances where the markets could correct, but I think eventually the market gets convinced by the economic growth and earnings growth, and therefore we've, at least in the past two occasions, sees positive returns. And that comes to my favorite topic of something that we've talked about very consistently over the last few months, that our bullishness on the markets is not just based on liquidity and Fed tightening and interest rates and things like that. It is the big support in our view that the market has got, and our belief that we are in a genuinely secular bull market is based on the strength of the earnings of the corporate sector. And we've seen now data is available for the second quarter of this financial year and the first full half of FY22. And if we look at the data for the Nifty companies, and here I'm not going to compare the first half of this year with the first half of last year, because the first half of last year was unusually low. I'm going back to the year before that, which is the pre-pandemic first half of the year. And if you then compare what the performance has been, you will see that the Nifty companies delivered first half to first half a 13% revenue growth, a 32% EBITDA growth, and a staggering 72% PAT growth, which means that in the first half of this year, the aggregate PAT of Nifty companies is 72% higher than what we saw in FY 19-20, right? So even if you take away the low base of last year, you will see that corporate performance has been very, very robust. More importantly, we've also seen a consistent upgrades of Nifty earnings estimate after the second quarter. And if you look at the numbers, initially pre-Q2 numbers, the total Nifty earnings estimate, right, for FY22 was 40%, and 42% for 22 and 23 are now at 42 and 45% for 22 and 23 after the Q2 earnings, right? And we believe that this continuous upgrades of earnings means that analysts are still behind the curve, and the Nifty companies continue to surprise on an aggregate basis on the basis of the earnings. Now let's talk about not just the Nifty earnings, but what happened to the Alchemy portfolio companies. And we've looked at the data of Q2 of all our aggregate companies within our universe, and we find that while Nifty revenue was up 33%, our portfolio company revenues, and now this is Q2 of this year versus Q2 of last year. So yes, the base is low, but if you do apples to apples comparison between Nifty and our portfolio companies, the Nifty revenue was up 33%, and our underlying portfolio companies delivered an aggregate revenue growth of 39%. The Nifty year-on-year EBITDA growth was 22%. Our portfolio companies delivered double of Nifty at 43%. And while the Nifty PAT was up 57%, our PAT was a staggering up 68%. So we believe that the strength of the bull market that we've been talking about, our continuous messaging to our investors that you should not be worried about valuations, is because we believe that earnings growth continue to be very, very strong. Yes, there could be a risk and bond yields will go up, which means that the discounting rate will get impacted, and therefore there would be some moderation in price earning multiples as we go along. But we believe that the earnings growth should take care of any moderation in PE ratios. With that, we now come to the last bit, which is also a very important reason why structurally we will have a very solid bull market in India. And we've mentioned this before, but it would be interesting to see the data that is available to us. One of the most important element recently has been the amount of money that has been raised in the IPO market, right? India's IPO market are now very, very robust, and it is evident that even just in the month of November, we raised a staggering 36,000 crores of IPO money, which means that today there is abundant risk capital which is available to companies as they go IPO. And this is a very important, because India has traditionally been a very capital scarce economy. The more risk capital companies are able to raise, the more solid will be the growth prospects going into the future. Now, obviously, we have to be extremely selective about which IPOs that we should go after. But having said that, I think the robustness of our capital markets is seen by the fact that many companies are able to raise record amounts of money. Secondly, and very heartening, is the number of new demat accounts. Now, we all thought that possibly post-pandemic, as things were locked down, people had not much to do, and therefore they started looking at investing in equity markets, and we saw a surge in new demat accounts. But what is heartening is that 18 months out post the pandemic, we still continue to see a very healthy run rate of new demat accounts that have been opened. And the total number of demat accounts now, the run rate is moving to almost 4 million new accounts every month. And the same was the case in October, where in first half we had 70 million new accounts, and in October itself we opened 4 million new accounts. And this bodes very well because you're continuously seeing new set of investors that are coming to the equity market, and there is a structural shift in the asset allocation of investors where people are moving from not only investing in fixed income and hard assets, but are also allocating increasingly more and more towards equity, which is making our markets deeper and the penetration is improving. And as we've said in the past, that despite the fact that we've seen some very aggressive selling by FIIs in the last few months, we've still seen that the markets are able to hold on in its own because there continues to be a strong inflow of domestic household savings into equity markets. And this is not something that we should ignore. And we believe that it is a big structural factor in India for the continued strength in India's equity markets and the deepening and the maturity of India's equity markets. So with that, we come to end to this month's update. We are heading towards the end of the year. It's going to be a festive season. I wish all of you the very best. Be safe, take care until we catch up again in the new year. Bye-bye.